SPY, which is called the Spider. And that's what this portfolio has done, which is clearly, given what we are, up 24%, pretty good for the year. Most people, the S&P 500, I think, is flat on the year. Right now.
Kelly, I'm gonna pause you there because I screwed up here. I screwed up live on the internet. We were not live this whole time. It was just you and me talking.
Okay, let's do it again.
Sorry, we're gonna need to do that again.
Start over.
A little bit of a blooper reel. My bad. My bad.
5 minutes.
I'm sorry about that. Okay, so for those of you just joining us, Kelly and I were talking. We thought we were live this whole time, but we weren't. Technical difficulty. My apologies. So Kelly, let's start that again. This is the we have three smart folios here that are included for free, absolutely free on the iFlip app, and we were just going to go in order from left to right. And what we were talking about is that if I click on the oldest portfolio, which is the SPY Plus portfolio, this was released with the app back in January, pre-COVID, pre-crash, when the market was still achieving all-time highs and everything was great. All the way back in January, I deposited $1,000, and right now, if we're looking at this, you would never, based on this line from January till July, the past 6 months, it doesn't visibly look like there was any crash.
Correct.
So Kelly, can you illustrate for us once again, why does it look like this? Looks great, 24% for the year on the SPY Plus. It doesn't look like there was any crash. Your comments on this, Kelly?
Again, the way our smart folios work, and as you saw briefly there, Aaron, there's 3 smart folios: the SPY Plus, the Red Oil, and the SPY I. They're constructed in such a way where they're managed robotically by algorithms, intelligent algorithms, learning algorithms, artificial intelligent algorithms that manage the market on an overall basis. So as you can see here, this particular SPY Plus Smart Folio consists of owning the S&P 500 Spider, which is the proxy ETF for the Spider.
Right.
And it also owns Apple in that ratio, 60-40. And so when you bought that back in January 22nd, there was no COVID at that time, or it was actually just a rumor, really,
right?
At that time. The real occurrence where the market really drove down was in March. And as you can see, your portfolio did go down somewhere in the beginning of March. You can see it right there, the end of February, March. Then it started to pull back, but then the critical time of the market was in the middle of March, where the S&P 500 made its low. And if you can see on this chart, you'll notice that the Smart Folio had you literally flat. You were actually out of Apple and out of the S&P 500 Spider simultaneously. That's the reason why the line is flat, because you had cash at that time. And even though it was,
I'm not investing at all. I'm not.
You're not. You may have bought the Smart Folio, but the Smart Folio, being hopefully considered a smart folio, actually held you out of the market for about 9 days, from the 10th to around the 19th, I think. Right.
Yes.
There, right. And so after that, it puts you back in the market. And if anybody looks at a chart of the S&P 500, you'll see that those were the 9 days where the market absolutely was destroyed. I think it was down around 7%. This portfolio was able to avoid that catastrophe. And that is fundamentally what we try to do at Flip, is give you this experience where you participate in the market when it has a reason to participate in it, i.e. it's going up. Right. And if it shows signals of going down, you're out. And it's the same way a person, when you go to Las Vegas, you don't always sit down and play blackjack. You do have to take a break And it's the same thing with trading in the market. When there's times when you just really need to take a break, and the system is smarter than most people, and it took the break for you.
That is amazing. So just I literally this area right here is the difference between the S&P performance now by buying and holding, and versus investing in this smart folio, right?
Correct.
This period right here, because the S&P, if I were to have just bought and held, I would have crashed with the market that 30 something percent, and it would take so much more to break even, and then and ultimately, start making gains again. Is
Correct.
that, do I have that correct?
You have that perfectly correct. I think I encourage anybody to go look at the S&P 500 during the March 10th through March 19th and see what it did. And
Absolutely.
I think you will find that the market didn't do well at all. And it would have been nice to say, oh, I wish I could have I wish I could have avoided that. With our smartfolio, you could have.
Mm-hmm. Now, to be clear, it's not like your algorithmic intelligence understands that what COVID is, right? It's not. It responds to the price action of the stock market as market makers do their thing, based on the news that comes out and the pandemic that unfolds.
Exactly. And I mean, it fundamentally, at Flip, we're believers that all information is formed in can be explained in the price. So price reflects, in saying it conversely, price reflects all known information in the market and an assessment of it. And so the earnings to come, the analyst opinions, the dividends paid, the announcements offered by company insiders is all interpreted instantaneously in the price of any stock. Participants are literally looking at a stock in microseconds, and therefore trying to make judgments of the future based on an expected earnings, or a possible COVID event, or a terrorist act, God forbid, is meaningless. Because when they do happen, the real people that do well are the people that react fastest.
Right.
Who is the fastest to react? Well, algorithmically, you can react much faster than you could is if you were with a money manager, or you have a buy and hold strategy where you don't react at all. You just accept the fact that you're going to go through a typhoon, and you hope you don't sink while you're in it. That's unacceptable. We do have a lot of information that's given to us in the market every day. The key is to be able to act on it, and act on it quickly. And that's how we do it. We do it through instantaneously computer-driven algorithms and intelligence that acts on data instantaneously.
Thanks, Kelly, for that explanation. I'm absolutely so happy that this is the way that I'm investing. I do have a question for you though, because it's not just the S&P in this SPY Plus Smartfolio. It's also, you also have have Apple, and yep. Apple has been the app, I noticed, has done a little bit more activity with Apple, and this is the history over here. And we're seeing that it's done a lot more of buying and selling of Apple in the past few months. You can see March 19th right here. March 19th is where it bought the spider, the S&P, and it hasn't really done. It just bought and held. It hasn't really done anything with it. If I had continued to contribute more money, I'm sure it would have bought more. But Apple, it bought and sold a couple of different times. Can you explain why it did that with Apple?
Yes. Again, the idea is to be able to look and interpret information that comes into a stock, to be able to whether you should own it or not own it. And so there are multiple pieces of information that these that the software uses in order to determine when to buy and when to sell. And what it's really looking at is trying to figure out when you have the best risk-reward ratio to be able to enter into a given trade. So that's why it will buy Apple or the S&P itself periodically, or sell it periodically, because risk-reward ratios are changing constantly. So on given rallies, it might sell it, try to buy it back cheaper, but if it can't, you might have a better risk-reward ratio even at a higher price. And that's something to understand. It's not always trying to buy it cheaper. It's just trying to buy it where it's more defendable position. So there is a lot of reasons why technology works the way it works, and just know that there is two components. It's not just trying to make money, it's also trying to manage risk. And that will explain why it periodically got in and out of Apple, even though Apple generally just went up from literally since the bottom of March.
Wow. You know, one thing that you said that really stands out to me is that even if the price is higher, it's possible for the risk to be lower.
Correct. Right.
Yeah. And whereas a lot of people, I think value investing, there's a lot of books out on value investing, and it's really a popular thought. And it's the idea of buy cheap, buy cheap, buy cheap. But whereas with the iFlip smartfolio, the thought is, the paradigm is buy with low risk. And that's
Correct.
not necessarily the lowest price.
Right.
Do I have that right?
That's right. No, but think of it this way. You're not going to ever see Amazon again, very likely, at $1,000 a share, right, unless it splits. So, but that doesn't mean that if I sold Amazon, for example, at 3,000, that I have to buy it at 2,800 for it to make sense. Maybe I could buy Amazon at 3,200 with better risk-reward characteristics there than I would at buying it currently at 3,000. Again, awesome. It's always changing because of the information that comes into the market every day changes risk-reward parameters, and that has to be understood.
Absolutely, absolutely. And next up we have the SPY portfolio and the red oil portfolio, both of which were created post-COVID, or during COVID, I should say. Let's talk about, let's go in order, because the SPY was the first one of the two to come out. And if we're looking at, well, this is the day chart, and this is a little bit more choppy, a little bit more, there's a little bit of an up and down kind of situation going on over here. Your thoughts on this portfolio, Kelly? What is the thinking behind this? All
right, so here's another thing we do at Flip. We want to be able to take advantages of certain criteria that are not necessarily data-based, but they are based on information over a longer period of time. So what the SPY and it's subsequently the red oil products is two more smart folios that are designed to capture over a period of time, in this case, 2 years. We're looking at after COVID came out. Clearly, a few things happened. One, a lot of the companies that exist out there that are demand orientated, for example, cruise lines, financials, banks, oil, all were devastated. They all went down. The cruise lines went down 2/3 of their value.
Right.
Banks went, literally, most of them got cut by at least 1/3 or a half. So you have those kind of companies that went down dramatically. You have companies that supply restaurants. Well, if COVID comes out, nobody can supply a restaurant. Why do I want a restaurant supply company like Chef, for example?
Right.
Well, the idea with this construction was not to algorithmically move in and out of the market. The idea of this construction is for people to have a one-stop smartfolio that owns a little piece of all of these companies that have been devastated, and say, let's try to find a way to own these stocks and manage the risk of doing so in the event that we have no recovery, and also in the event that we have a recovery. So I think most people out there would agree that the market at some point in the future will recover. In other words, a vaccine will develop, time will have gone by, and the fear of this pandemic will subside. And that will put people back into a demand-orientated position. So in other words, they will travel more. They will use more oil in their cars, more gas, because they will travel more. They might take cruises again in the future. They might go out to restaurants again in the future. These are companies that if you look at them, look at the construction, Carnival Cruise Lines,
Right.
S&P 500 growth,
Right.
ExxonMobil, AT&T, Bank of America, Chef. With the exception of Chef and maybe the SPY-G, which is, again, just the S&P 500, but the growth piece of it. So, for example, a higher weighting towards Apple and Amazon, things like that. Those are stocks that most people may not know, but these are the kind of things that people should have exposure to if they expect a recovery. So what we did is we created an index. And what we did is we dollar weighted the index. So, for example, the SPY-G was at the time around $40 a share, and Carnival Cruise was around $12 a share. So to dollar weight this index, you would buy 3 Carnival Cruise Line shares for 1 share of SPY-G, and you would buy about 3 shares of Chef, 2 shares of Bank of America, 1 share of AT&T, and 1 share of ExxonMobil. So what we did is bought those ratios of stocks, and then we created an index. Now the index means we add all those up, weighted, and then we run an algorithm on the index.
Got it.
And the idea is to say this. Most investors want to take a 2-to-1 bet.
Right.
Here's the 2-to-1. The bet is that if you put, say, $600 into the SPY-I, the odds are that it will go up 2 times are higher than it would go down just 1 time. It means this. It means that that $600 you put in has a chance to go to $1,200 before it has a chance to go to 0. Right? So in other words, you could lose before it goes to 300, because the goal is to make $2 for every one. So we think that the construction of this was designed such that it will go to $1,200 before it went to 300. Make $600 on your 600 or lose 300. And it's an all or nothing bet. Over the next 2 years, if the COVID virus were to subside and we have a vaccine in 2 years and people have less fear, the odds are that there will be recovery in the bank stocks, the cruise lines, the growth stocks are already doing well, that this portfolio has a chance of making 50% over each of the next 2 years. That's a pretty good return.
It is.
And it has a 2/3 chance. Again, the construction is this. It has a 2/3 chance of that occurring, but it has a 1/3 chance that it could go down by half.
Got it.
In other words, these stocks could get halved again. In other words, Bank of America was at 42. It went down to 22. There is a chance that Bank of America goes to 11. But the odds are highly against it. And it becomes even more highly against it when you own many different stocks that would all have to do that.
Got it.
For you to lose the $300 of your $600 investment. So that's
you actually answered my question, because I was actually going to say something about Carnival, because a lot of people are very bearish on Carnival because of because of the situation right now. You know, I don't have to explain. Everyone knows what the situation is with cruise lines, I think.
We
If not,
understand
you
that,
can
but that
connect the
doesn't,
dots.
right, but,
Yeah.
sorry to talk over you, but
No, please.
yeah. Look, I remember when everybody was bearish the banks and Warren Buffett came in and bought Bank of America at $4.50 a share. He bought $5 billion worth. Everybody hated it. Oh, Bank of America is going to go under. It's got to go under. It's in the 2008 financial crisis. All the banks were murdered.
Right.
Well, obviously, I'm not Warren Buffett, but at the same time, look at what he did. Warren Buffett's bets are generally 10 years or more in nature. My bets and the bets of Flip are, since I have no crystal ball, and neither does anyone except maybe Warren Buffett, who, by the way, retired.
Right.
Is that over the next 2 years is actually a little easier to predict, because during 2 years, all kinds of things can happen. And it's easier to predict tomorrow than it is a year from now in general. And so the bet here is just that if you want to say over the next 2 years, how do I own these stocks that nobody likes in such a way that I can possibly be protected by the other stocks around it? So if you notice, CCL is surrounded by other stocks like Bank of America, AT&T, oil company, growth stocks, in this SPY-G, and another stock that nobody would like, which is Chef, which is a company that actually supplies food like Cisco does to restaurants. Of course you hate them. Everybody hates them. But because they hate them is really when you should be looking at them. And so what we do is we surround these stocks with other things that have been hurt so that we can get the lever from them if there's a recovery. And I think most people would agree that we likely will recover from this pandemic.
Yeah.
And if we do recover from it, I feel strongly the design of this and the index shows that this index periodically over long periods of time can double or triple. And in this case here, the projection is two-thirds probability over 2 years that this portfolio literally doubles in value. And a 1/3 probability that it will become half of its value. So that's why you saw the volatility. By the way, go right back to it real quick and we'll finish off on it. And there was that little spike you can see when you go to all, right? That spike there was prior to the cases going up in COVID. The market was literally flying. When you got up there, you put in about the 600, it already went up to 27% higher within actually a week. But it gave that back. Why? Because all of a sudden there was a thing, oh no, we're going to be in this COVID environment longer than we thought. And that was just the optimism of a vaccine or treatment. And now that optimism waned. It will wax and wane again. But the longer the time goes by, the more probability is that there will be better treatments for the COVID virus, and also that there will be a vaccine. And if that occurs, you can bet that even if the economy doesn't completely recover, these stocks will recover, not even to their previous highs. And if it doesn't even go to their previous highs, it will still double in value.
Right.
So that's why you'll see much more volatility in this. These things are related literally to the current environment.
Yeah, that's remarkable that these stocks don't necessarily even have to reach their pre-COVID prices for this smartfolio as a group to double in value. That's really powerful.
Right, exactly. They don't have to go back to their highs.
Right.
They don't have to. I don't expect that.
That's great. And the other thing that I'm noticing about this, and I think the red oil smartfolio is going to be a good example of this as well, is that you're not trying to time the the market in this case, whereas with the S&P, it was more of a timing mechanism algorithmically. This is more of a like you said, it's you're betting on the world to recover from this, essentially.
Right. It's a recovery bet. And so people, a lot of times they search for saying what things will recover. I agree. Exxon will probably recover. Carnival probably will recover. But at the same time, put some other things in there that we know these are not stocks that are going to go anywhere.
Right.
I don't think AT&T is going out of business. I don't think Bank of America is going out of business. And if Carnival and Chef both went out of business, you still wouldn't even lose half of your money. And so this isn't something that a person, if a person has $100,000 of net worth, you don't buy $100,000 of this. You don't buy $50,000 of this. But you do buy $10,000 of this or $15,000 of this, because this represents something that can give the rest of your portfolio a lot of firepower. It gives you a lot of juice. And the good news also is that if you don't have a lot of money, it's a great way to start in the market, because they are good stocks and they are very likely to give people a good feeling 2 years from now. 2 years from now, let's all again, I think we said this on the last podcast, let's take a look at this portfolio.
Yeah, absolutely. Let's finish up with the red oil. A lot of the type of the thinking, the paradigm, the fundamentals that you just talked about apply to red oil as well, but it's more specifically surrounding the oil sector and industry. So I guess the first question is, here are the four companies, the oil companies that you selected to be in this in the smartfolio. Why the oil? Why the oil sector? Well, what's special about the oil sector?
Okay. Again, the construction is identical to the SPY that we just talked about.
Okay.
So we did the same thing. We created an index, dollar weighted. So again, if Oxy was twice the price of Halliburton, Oxy Petroleum, I would buy 2 Halliburton shares for every 1 share of Oxy.
Right.
Because they're all equally weighted, as you can see.
Right. Mm-hmm.
So we construct it, build an index, and we do the exact same thing. But this one has a different caveat. This one's all focused in oil or oil servicing companies like Halliburton or Schlumberger. So let's think about this. The reason that these stocks were devastated was because of the COVID environment. Nobody's allowed to travel. In New York, were you allowed to travel? No. Could you get into your car? No. In Arizona, even if you could travel, which we could, it didn't matter, because at the end of the day, there's nowhere to go. So you don't need gas. That's why gas prices fell down. So these companies obviously were again devastated. ExxonMobil was trading in the 70s. It went all the way down to 32, 33. And now it's on a bounce back to 42. But it just, again, just like the other ones, when this system is highly sensitive to the recovery of the economy vis-a-vis the ability to fight the virus. So if we fight the virus, the economy recovers. But there's one difference between this one and the others. Mm-hmm. This one has huge dividends. So this one has 2 things that make anybody have to look at this in a reasonable way. First of all, it's just like the other one. There is a 2/3 probability that this portfolio will double in value before it loses half of its value. So again, we're going to try to make $1,000. You put $1,000 in. You're going to buy the appropriate number of stocks. You're going to try to make $1,000 over 2 years. But you don't want to risk. You're going to risk 500 to do that. Most people like to take a 2-to-1 bet. I do.
Right.
But there's another facet of this one. If we have an economic recovery, these stocks have very high dividends, especially at these current prices.
Got it.
what could happen here is, in the short run, it's highly probable that some of these companies will cut their dividends, right? They don't have the income streams to pay dividends.
Makes sense, yeah.
Oil companies have one great thing about them. They have income streams, cash flow. Because they have cash flow, they can pay dividends. But if nobody's buying their product, the demand is down, they don't have necessarily the cash flow to pay their dividends. Well, so far, each one of these companies has paid their dividend. That's
awesome.
Number one. The dividend yield on all four of these stocks is in north of 10%. So I would challenge someone that the bet here, when you buy the red oil, and it's called red oil because all these oil stocks are in the red, is very simple. What happen is that even if there was no dividend, the price is likely to double than it is to have. So that's a reason to buy it right there. But
thanks Kelly. I think we're gonna actually get disconnected here because there's a limitation on this. Thank you for joining us today. Make sure you hit subscribe and follow on YouTube, and you will get notified for the next update from Kelly Korshak. Thanks, everybody. Sorry, Kelly. It was gonna.
No worries. I know why. You don't have to say it. No, perfect.
It was gonna.